Hey, Dan Passarelli here. I've been spending some time reading up on some trading technique, and I was looking at trend following systems, specifically moving average trend following systems. And there's a number of different ways you can do it. For longer term trades or even for investments, one of the best things to do is just take one of the longer term moving averages, the 50-day, or if you're an investor, probably the 200-day. And basically, as long as the stock or the ETF or whatever is above the 200-day moving average, you just stay in it long. And when it goes down below it, you sell out of it. And then when it goes back above it, you buy back into it. So what that mainly does is it keeps you out of these really sketchy areas of the market. But it's possible to negative scalp a little bit. Like here, you probably would have sold somewhere around here, maybe around 569, 568, but would have ended up getting in somewhere around like 577, 580 or something. There's a couple questions. One, is it worth it to negative scalp? And, we're just looking at one thing here. If we were to look at a longer term time horizon, and I'll look at a 2-year chart. I mean, this was a little bit of an anomaly market here, so would have got you out here and got you back in here. And you're able to, you end up doing some of these whipsaws. I'm going to cram a bunch of data into 5 years using a 1-day aggregation period. So if we looked at it here, it would have been out, in, out, in, out. And this would have worked out pretty nice. It would have avoided this. And then you would have probably got back in here and negative scalp just a little bit, but not really getting back in until here. A couple negative scalps maybe around here. No, actually, this one would have been a positive scalp. So really, over a 5-year period, probably the negative scalps would have balanced each other out. You probably would have outperformed the market a little bit. That's what some of the data that I've seen show. But if your goal is really to outperform the market, you probably want to get back in at some of these low points. Now, nobody ever buys the exact bottom of the market. That's a bit of a fool's errand. But, to be able to buy around 520 here, I mean, even if able to buy around 540, that ends up becoming a real benefit. And so with the pure trend following system, you're probably able to outperform. I mean, the data show you can outperform the market a little bit. And if you do that over a long period of time, the compounding, it does make a difference. But if you combine that with selling puts, cash secured puts, at some point when the market hits a low enough level. Now that's very, very subjective. You'd have to set up some criteria. But a level far enough below where even if you set it, you would have taken you out at 570, so that would have been 10% lower. You set it 10% lower down here at 520. If you got filled, wonderful. If you didn't get filled and you ended up skating on the put, it's actually wonderful too. So combining a long-term trading or short to medium to long-term trend following system with cash secured puts and with covered calls, towards the upside, that can make it even a much, much stronger system because it can get you into the market earlier or generate some cash while you're out of the market. I hope that helps. This is Dan Passarelli, Trade Smart, and have a great weekend.